Assalamualaikum warahmatullahi wabarakatuh. My name is Cindy Nabila from MI20 class, and in this time I will to explain about beta. How should investor assess risk in the stock that they buy or sell? While the concept of risk is hard to factor in stock analysis and valuation, one of the most popular indicators is a statistical measure called beta. Analysts use it often when they want to determine a stock risk profile. However, while beta does say something about price risk, it has its limit for investors looking to determine fundamental risk picture. Okay, so what is beta? Beta is a measure of a stock quality in relation to the overall market. By definition, the market, such as the S&P 500 index, has a beta of 1.0, and individual stocks are ranked according to how much they deviate from the market. A stock that swings more than the market over time has a beta above 1. If a stock moves less than the market, the stock beta is less than 1. High beta stocks are supposed to be riskier but provide higher return potential. Low beta stock pose less risk but also lower return. Beta is a concept that measures the expected move in a stock relative to movement in the overall market. A beta greater than 1 suggests that the stock is more volatile than the broader market, and a beta less than 1 indicates a stock with lower volatility. Beta is a component of the capital asset pricing model, which calculates the cost of equity funding and can help determine the rate of return to expect relative to perceived risk. Critics argue that beta does not give enough information about the fundamentals of company and is of limited value when making stock selection. Beta is probably a better indicator of short-term rather than long-term risk. Sorry. Beta is a component of the capital asset pricing model CAPM, which is used to calculate the cost of equity funding. The capital asset pricing model formula uses the total average market return and the beta value of the stock to determine the rate of return. That stockholder might reasonably affect based on perceived investment risk. In this way, beta can affect a stock expected rate of return and share valuation. Okay, then calculating beta. Beta is calculated using regression analysis numerically, and it represents the tendency for a security return to respond to swing in the market. The formula for calculating beta is the covariance of the return of an asset with the return of the benchmark divided by the variance of return of the benchmark over a certain period. Okay, so beta same covariance divided by variance. Okay, next the advantage of beta. Two followers of JVM, GIVM, beta is useful. A stock price variability is important to consider when assessing risk. If you think about risk as the possibility of a stock losing its value, beta has a file as a proxy for risk. Intuitively, if it makes plenty of sense. Think of an early stage technology stock with a price that bounces up and down more than the market. It's hard not to think that stock will be riskier than, say, a safe have utility industry stock with a low beta. Besides, beta offer a clear, quantifiable measure that is easy to work with. Sure, there are variations on beta depending on things such as the market index used and the time period measured. But broadly speaking, the notion of beta is fairly straightforward. It's a confidence measure that can be used to calculate the cost of equity used in a valuation method. And next, the disadvantage of beta. If you are investing based on a stock fundamental, beta has plenty of shortcomings. For start, beta doesn't incorporate new information. Consider a utility company. Let's call it Company X. Company X has been considered a defensive stock with a low beta when it entered the merchant energy business and saw more debt. X history beta no longer captured the substantial risk the company took on. At the same time, many technology stocks are relatively new to the market and thus have insufficient price history to establish a reliable beta. Another troubling factor is that fast price movement is a poor predictor of the future. Beta as merely rearview mirror, reflecting very little of what lies ahead. Furthermore, the beta measure on a single stock then to flip around over time, which makes it unreliable. Credit for trader looking to buy and sell stock within short time period. Beta is a fairly good risk metric. However, for investors with long-term horizon, it's less useful. Assessing risk. The well-worn definition of risk is the possibility of suffering a loss. Of course, when investors consider risk, they are thinking about the chance that the stock they buy will decrease in value. The trouble is that beta, as a proxy for risk, doesn't distinguish between upside and downside price movement. For most investors, downside movement are a risk, will upside one mean opportunity. Beta doesn't have investor tell the difference. For most investors, that doesn't make much sense. There is an interesting quote from Warren Buffett regarding the academic community and its attitude toward value investing. Well, it might be alright in practice, but it will never work in theory. Value investors scorn the idea of beta because it implies that a stock that has fallen sharply in value is riskier than it was before it fell. A value investor would argue that a company represents a lower risk investment after its fall in value. Investors can get some stock at a lower price deficit the rise in the stock beta following its decline. Beta say nothing about the price fight for the stock in relation to fundamental factors like change in company leadership new product discoveries, and on future cash flow. Stock beta will change over time because it confronts the stock return with the return of the overall market. Benjamin Graham, the father of value investing, and his modern advocate tried to support well-run companies with a margin of safety that is an ability to withstand unpleasant surprise. Some elements in safety come from the balance sheet, like having a low ratio of the to total capital. Some come from the consistency of growth in earning or dividend. And important one come from not overbuying. For example, stock trading at low multiple of their earning are viewed as safer than stock at high multiples, although this is not always the case. The bottom line. Ultimately, it's important for investor to make the distinction between certain risks where beta and risk volatility are useful and lower term fundamental risks where big picture risk factors are more telling. High betas might mean price volatility over the near term, but they don't always rule out long-term opportunity. Okay, I think enough for my explanation about beta. Thank you for attention and see you again. Wassalamualaikum warahmatullahi wabarakatuh.